The YieldMax Ultra Option Income ETF, ULTY, has quickly become one of the most talked about income ETFs in 2025. Now its promise of generating weekly income from a portfolio of covered call strategies and its promise of high double-digit distributions has drawn many income investors and traders seeking consistent cash flow. But recently, many ULT investors have been worried. On the latest Friday session, the overall market has pulled back sharply, and many of ULTY's underlying holdings have been dropping as well. This is going to include some of the holdings such as Coinbase as well as Microstrategy, which have sharp declines. And while the protective puts in place that are designed to prevent a downside, it did help soften the blow. As we can see, it's not even down 1% last Friday, but we're still going to see declines in the ETF because it's not a perfect hedge. And especially since we're down 2% in the past week, which is not really too crazy, going from about $6.10 all the way down to $5.90. A lot of people are pretty worried. Now on August 13, when this ETF paid out a 10-cent dividend, it did drop at market open, but that is completely normal. And for the past few weeks, as well as past few months, normally you would see the share price directly recover. But that is not the case with this last week. It did not recover from its dividend, and we're seeing a pretty sharp decline in ULTY that we've never really seen before since we've been in a pretty good bull market for the past few months. Now this raises an important question. Is ULTY destined to keep dropping, or is it just experiencing normal volatility? But before deciding to buy, hold, or sell ULTY, there are some key points every investor must understand. And the first one is ULTY is an income fund, as the name suggests, not a growth fund. So the first thing to understand is that it's going to be income first and capital growth second. Like most covered calls, ULTY's strategy involves holding a portfolio of stocks. Now in this case, it's going to hold between 15 to 20 to 30 very volatile holdings, because that's how we're going to be achieving that 80% distribution rate that we know and love. And that is going to only be achievable through the most volatile stocks in the market that we're hopefully bullish on. And that's going to include names like Coinbase, Rigetti Computing, AST, Space Mobile, AppLovin, as well as exposure to Microstrategy and Mara, as well as Reddit and Hood, which have been doing really well the past few months. And then it's going to sell covered calls against those underlyings. And because these are all high implied volatility stocks, we're going to be getting that juicy option premium in return to investors in the form of distribution every single week. And before the strategy change, ULTY was known for having over 100% distribution rate, but we're seeing it a little bit lower because it does end up hedging its portfolio a little bit by buying far out of the money protected puts in case any of these underlying holdings end up just absolutely tanking like a rock. So what does this mean for ULTY? Well, you're going to get frequent high income distributions, often between 70 to 80% as we've been seeing, but you're going to give up a significant upside potential in the underlying holdings because the covered calls are of course going to cap your growth. So if we say Coinbase goes to $1 million per share, of course that's an extreme example, ULTY, we're not really going to see $20 per share in the share price, or even possibly $10 in the share price. It may go up a few cents, maybe $1 if Coinbase does really well. But ULTY is designed to just pay out consistent income every single week. And that's what we really have to remember with the ETFs. So if you're comparing ULTY to a growth-oriented ETF such as QQQ, which is actually up about 0.5% in the past week compared to ULTY, you're comparing apples to oranges, since ULTY is designed to generate the cash flow, not long-term price appreciation. And if that is not your goal, then maybe considering investing in a different asset such as QQQ, which has very good growth appreciation, would be better suited for your portfolio. Now, the second point is ULTY is, of course, still going to drop when the overall market drops. We can see QQQ, which is the NASDAQ 100 index, is down about 0.44%. Now we're going to see ULTY drop as well. It's down maybe double QQQ at 0.84%, but we're also having more volatile holdings as well as less holdings in this ETF, as it only holds between 15 and 30 stocks. And if we take a look at the chart for ULTY, a common misconception is that ULTY is somehow immune to market downturns because of its protective puts, but that's not the case, because protective puts are designed to limit extreme losses, not eliminate all the downside. So if some of ULTY's holdings drop, maybe as an extreme example, 90%, ULTY will still reflect a decline in share price just with some cushion. And we made a video earlier about the best and worst market types for ULTY. In prolonged bear markets, ULTY will continue to lose value even while paying out high distributions. So the bottom line is ULTY is less volatile than holding the peer stocks directly, but it's not completely risk-free, and investors should be comfortable with short-term declines. Now, the third point that you have to know is you have to actually be bullish on the underlying holdings. And that is going to require constant monitoring of the ETF as they are constantly buying and selling different assets. So if you see some of the holdings such as Coinbase or AppLovin, you're not loving the holdings that they are holding, then maybe this is not the right ETF for you, because they are holding shares of these underlyings. And if you're not bullish on the underlyings, you're not really going to want to invest in this ETF. So every few days, you want to take a look at the holdings and ask yourself if you believe in the long-term growth of these stocks. And are you comfortable with the volatility? Remember, it's going to choose the most volatile stocks that the fund managers believe are bullish on in order to generate massive distributions week over week. And you also have to think if these companies will at least hold their ground while ULTY extracts income through options. And if the answer is no to any of those above questions, then ULTY is definitely not the right fund for you. It's like, why would you invest in TSLY if you're bearish in Tesla? It just does not make sense, in my opinion. Now, while it does pay out high distributions, that is not a good reason to invest in something like TSLY if you don't believe in Tesla. Now, the fourth point is you have to understand when it's time to sell. A lot of people love ULTY so much that they are never going to sell this ETF. They struggle with the decision of when to exit a high yield ETF, and the truth is you don't have to hold ULTY forever. There are other options out there. We now have 50 different weekly paying ETFs, and there are more coming to the market every single month. So if you feel that the fund is underperforming compared to your expectations, or if it no longer aligns with your own financial goals, it's okay to rotate it into something else. If you can't stomach the volatility that ULTY has, maybe something like QQQI or even SPY by Neos would be better suited, as these are going to have a little bit stable more of a NAV as well as consistent dividends, but it's going to be monthly, so that's a little bit of a trade-off, as well as lower distribution rate because it is going to be, in my opinion, less risky. And it's also good to not over leverage into a single ETF, especially ones with high risk, high reward. ULTY is most definitely high risk, high reward, and a lot of people think it's very low risk, and that's just not the case. Because while it has been consistent since April, so ULTY definitely has to align with your goals. I've gotten some emails of people nearing retirement or just about to retire in their 60s thinking that ULTY is an ETF to retire on. And we have covered many hypothetical situations of retiring on ULTY, how much you need, but it shouldn't be 100% or even more than, in my opinion, 25% of your portfolio. It is a high risk, high reward asset. And for those people who are looking for something safer, I highly recommend either the NEOS funds, SPY or QQQI, which are going to be a little bit more stable. It's going to give you monthly income, and it's a great addition to your portfolio, in my opinion. Or, in my opinion, if you can't stomach any volatility, SCHD is going to be one of, if not your best bet. Now, of course, this is not financial advice. You have to do your own research. I can't stress that enough. And what works for one person may not work for you. But there are tons of different ETFs and stocks out there that there has to be at least one that would align with your goals. For example, if you rather invest in treasuries, long-term treasuries, TLT is going to pay you a monthly dividend of about 4% APY, which is absolutely amazing. And if you do believe that interest rates are going to end up dropping, this is going to rise in share price appreciation as well. So as you can see, there's tons of different assets out there. You have to do your own research, consider what your goals are, and see if some of these ETFs align with those goals. So the key takeaway for ULTY, if you're considering ULTY or already holding it, you have to keep in mind this is for income, very high yield income, not necessarily growth. We can expect the share price to eventually erode in value, but hopefully with the distributions week over week, you are going to be positive total return. Now, even though this ETF has dropped in the past month 6%, I'm still overall positive total return, factoring in all those distributions I have been receiving, even with a cost basis well over $6. And you also have to understand market downturns are still going to hurt. The strategy change back in late 2024 definitely was good. It helped soften the blow from underlyings ending up tanking, but it's still going to hurt the ETF in the long run. And you have to monitor the holdings regularly because they're constantly adding and removing different companies. So you have to understand that if you see a company that you don't really like, maybe consider selling out of ULTY. And you have to know when to rotate. If it stops aligning with your goals, if it stops performing the way it is, for example, maybe they pay lower distributions, that's not really why you invested in ULTY in the first place. There's other assets out there, and there's always going to be more and more coming out. I think that ULTY has paved the way for ETFs going forward. A lot of newer ETFs are using similar strategies with protected puts to kind of hedge and soften the blows. So it's definitely an exciting innovation in the income ETF space. And of course, we love getting paid every single week, which has been trending as of lately. Now let me know down in the comments, are you buying more ULTY? Are you going to sell out of it? I know a lot of people are considering selling out of ULTY, which is perfectly okay. Personally, I'm holding, possibly buying more, but I know ULTY is not aligning with a lot of people's goals lately, and that is okay to switch to different assets.